Okay guys, we're going to continue our discussion of Chapter 3. Remember, we are looking at what does a parent do in consolidation after they've acquired the company, the subsidiary. We looked at what happens at acquisition back in Chapter 2, and on Monday we looked at what the parent does in the first year after acquisition and the consolidation entries. And remember, it's S. First, you eliminate the subsidiary's book value at acquisition. A. Then we write assets purchased. Well, the fair value of those, we either write them up or down at acquisition. We remove or eliminate income of the subsidiary that's been recorded in the investment account because the parent is using the equity method when recording the investment in the subsidiary. D, we remove any dividends. And then E, we add any amortization back due to the difference in book value and fair value of assets at acquisition of the subsidiary. Now, let's take it to the next notch. That's what happens in the first year. What happens in subsequent years? And I would refer to your book so that you can come back to these dollar amounts and know what the heck we're talking about. So let's take a look. Assume January 1, 2020. So the purchase happened, the acquisition of, Sun took place January 1, 2017. Okay, so now we've been through 17, 18, 19. It's now January 1, 2020. They're telling a Sun company the subsidiary retained earning balance has risen to $600,000. Remember, when it was first purchased, on the purchase date, the retained earnings had a balance of $380,000. So this table is telling us why it rose. Sun has had net income. Sun has declared and paid dividends. So it's increased overall $220,000 from when Parrot first bought them. So how do we account or do our elimination entries, consolidation entries, due to, now, 3 years after the purchase? Well, first, due to the passage of time, we have to assume Parrot still owns 100% of Sun. Sun now has a $40,000 liability payable to Parrot. So they're throwing another little item in there. As of January 1, 2020, Sun's retained earning balance is $600,000, which we defined on the previous slide, why it's changed from $380 to $600, which is an overall increase in book value of $220,000. Now, what you have to keep in mind at this point is that all this time, the parent, Parrot, has been recording this change in book value. They've been increasing their investment for net income of Sun, and they've been decreasing it for dividends. So if you're sitting there thinking, what does that mean? Make a T account, show the net income for the last 3 years in the debit side, show and remember the initial purchase price of Sun was $800,000. So you want to make sure that's in the debit column as well, and then decrease it on the credit side for all those dividends in that prior table. Parrot reports an equity and subsidiary earnings of $153,000. So we're going to be seeing that when we're looking at consolidation. And I am on page, it's 97 of my book. It's probably like 96, 98 of your book. Okay, so you'll see in Parrot Company's consolidated worksheet, equity and subsidiary earnings is $153,000. Where'd that come from? Sun's income this year was $160,000. So remember, they debited investments, investment in Sun, and they credited equity in subsidiary earnings. Let me just check I have different dates, so I just want to make sure I'm jiving with you guys. Come on. Where's my table? Oh, there it is. Okay, so Let's see, 90. Okay, so yeah, so this is their income in 2020, so you know that. So 17 has gone by, 18's gone by, 19's gone by, and what we're looking at is December 31st, 2020's consolidation. Remember, they subtract out, it's not 7,000 in dividends, it's 7,000 in amortization. So the slide is incorrect there. Remember, at acquisition, the book value and the fair value of certain assets was different. That difference is amortized. 13,000 is amortized a year or expensed because of the patent difference. And actually, because equipment had less of a fair value, we're actually going to show that difference as like an income item. Too much in depreciation is being reported overall because the fair value was less than what's actually being depreciated, the book value. So the net effect of those two numbers is 7,000, a $7,000 expense. The annual accrue of Sun's income then would be 160,000. Remember, the receipt of the dividends though would decrease the investment 40 grand for 2020, and then we have to recognize an amortization expense. So here are the consolidation entries. First of all, we need to eliminate the subsidiaries' book value. Now, after acquisition, we're going to eliminate the current book value. What does that represent? 600,000 in retained earnings. Remember, it went from 380 to 600, a $220,000 difference. But you also have to remember our investment account changed by the same amount. So we debit retained earnings 600,000, debit the common stock 200,000 for the amount of common stock in Sun, and then debit additional paid in capital 20,000. We credit our investment account for the total 820,000. So we just eliminated the current book value of Sun. The next journal entry, eliminate A, acquisition value. So essentially, we have to write up the assets to their fair value less, and this is important, any amortization already taken. So trademarks, that hasn't been amortized. So we just show it as a debit of 20,000, the original difference between fair value and book value. I'm going to skip down to Goodwill. That didn't change. It was 80,000 at acquisition. We leave it at 80,000. But take a look at the patent. Originally, the patent's difference between book value and fair value was 130,000. However, that is being amortized over 10 years. So 13,000 a year has already been written off of that, recognized, or 39,000 of it. So how much should we really increase the patent? The 130 minus 39,000, or 91,000. The net of what's left still to be amortized. It's the same thought process for the equipment. Remember, the equipment's fair value is less than what its book value was at acquisition by 30 grand. That 30,000 is being amortized over 5 years. So the last 3 years, we've actually increased income because too much depreciation is being recorded due to the difference in fair value and book value, a full 18,000. So how much of the equipment is yet to be amortized due to the difference in book and fair? $12,000. So that's why those numbers are different than they were at acquisition. So we take the 20,000 plus the 91,000 plus the 80,000, subtract the 12,000, and debit investment in Sun Company $179,000. I eliminate the income. We show a debit in the equity and subsidiary earnings and a credit in investment in Sun Company for the net amount of investment earnings that the parent has shown in their books because they use the equity method. D, eliminate the dividends declared. So the parent has shown or decreased their investment account by $70,000 from the dividends Sun Company declared. So they'll debit investment and credit the dividends declared. E, record the current year's amortization due to the equipment and patent having a different fair value at acquisition. So we will, up in the top, debit amortization $13,000, credit depreciation expense $6,000. Credit the patent technology $13,000, and debit the equipment account $6,000. And then the final journal entry, which is brand new, is an intercompany. We said there's $40,000 that Sun, I believe, I can't remember which method it went, but Sun either borrowed it from Parrot or Parrot borrowed it from Sun. Whichever, there is a accounts or a notes receivable on the trial balance of one of the companies, and a note payable or accounts payable on the other one. So we would be showing that twice. We have to eliminate it. If we're reporting it as one company, a company can't loan itself money. So we debit the liabilities in entry P for $40,000, and we credit the current assets, entry P. And then we swing it across. And those are our consolidated totals. So take a good look at that in your book. So again, in addition to entries S, eliminated the subsidiary's book value, A, recording the acquisition write-up for assets or write-down, I, eliminating the income of the subsidiary, D, eliminating the dividends of the subsidiary, and E, record the current amortization due to the book value and fair value being different in acquisition of the subsidiary. Entry P eliminates an intra-entity payable. And that explains that there. Wow. Okay. So guys, those are the steps we take and the elimination and consolidation entries that must be done when the parent accounts for the investment under the equity method. Remember, the parent will debit an investment account when they purchase the subsidiary, but then during the year they will increase the investment for net income of the subsidiary, decrease it for dividends of the subsidiary. What we're doing with those consolidation entries is eliminating those items out of the investment account so that when we are reporting consolidated amounts, there's no doubling up of any figures. Not all companies, though, keep track of their investment account under the equity method. Some use the initial value method or even the partial equity method. So, when a company uses the initial value method, what they're doing is recording their investment at purchase price, no net income of the subsidiary directly in the investment account. They're not recognizing it anywhere. And when there's a dividend they receive from the subsidiary, they include it in dividend income. They don't affect their investment account at all. They don't record any kind of amortization effects on their investment account because of fair value and book value differences at acquisition. The partial equity method reports net income in the investment account, sometimes reports dividends in the investment account, and I think that's our assumption here, but doesn't record any effect of amortization in the investment account. Okay, so it gets kind of funky. Just 3 parents' accounts vary because of the method applied. The investment account, so the balance in there will be different under all 3 methods. So the elimination will be different of that account. There may or may not be income recognized from the subsidiary on the parent's books directly. And the parent's retained earnings periods after year of combination may be different under the three methods. Because under the equity method, they're showing net income directly in income. Under the initial value method, they're only showing dividends in net income, which would ultimately change retained earnings. Okay, so there's differences or different items that will affect the income statement in a year, therefore retained earnings. When it comes to consolidation, though, no matter what method you're using, we bring it back like you're doing the equity method all along. And that's where it gets funky. So let's take a look. Two entries for the initial value method are different from those for the equity method. So if you go to your book, it's my page 99, it's probably like around 98, 100 of yours. It says Consolidation Worksheet, Initial Value Method Applied. Entry S is the same. Okay, now you're eliminating the subsidiary's book value. Now, because you're not changing your, okay, let's see, that is as of, okay, that's as of the date of acquisition. Okay, because, I'm sorry, this, what we're looking at is the first year of acquisition. So we're not making it 10 times worse by assuming that the company's been operating 3 more years after acquisition. At the date of acquisition, you eliminate the subsidiaries, or I'm sorry, the year after acquisition. Sorry, the first year after acquisition. You eliminate the subsidiary's book value. So we're going to debit retained earnings 380, debit common stock 200, debit additional paid in capital 200, credit the investment in Sun Company 600,000. We still write up or down the various assets and liabilities that have a different book value to fair value at acquisition of the subsidiary. So in journal entry A, debit trademark 20, debit patent 130, debit goodwill 80, credit equipment 30,000. And then we will credit the investment in Sun Company 200,000. But take notice, at this point, all the investment account is written off. Yes, because the parent never increases the investment for net income from the subsidiary, doesn't decrease it for any amortization due to difference between book value and fair value, and never decreases the investment account because of dividends from the subsidiary. It's the internal bookkeeping of the investment causes different consolidation entries. So the first two are the same, but entry I, no. Where did Parrot record the dividend from Sun? In a dividend income account. Under the initial value method, that's what they do. So we need to debit that and credit dividends declared. Doesn't affect the investment, never was recorded in the investment. Entry D is not needed because that's dividends. Entry E is the same as the equity method. You still have to record amortization of the difference between fair value and book value at acquisition. That doesn't change. So we debit up in the top, amortization expense, credit depreciation expense, debit the equipment, and credit the patent. And then we swing it across. When the initial value method is used by parents, again, the income and investment accounts are separate statements. On the parent's companies, separate statements vary. Significant difference between the initial value method and the equity method. And remember, these aren't methods of consolidation. This is how the parent does the accounting on their books for their investment. Parent separate statements do not reflect consolidated income totals when the initial value method is used. So what they're saying here is if parent company does their financial statements just using parent company's information, there's no income from Sun Company on there using the initial value method. However, under the equity method, it would have been included because under the equity method, we debit the investment account and credit equity earnings. So it's all about how the parent records items related to their investments. What if it's the partial equity method? And that's another option the parent does. Well, turn your page. You should see a consolidated worksheet there, partial equity method. Entry S and A are the same. I'm not going to go through them again. You guys could look at that. You eliminate the subsidiaries' book value of equity. You then write your assets up and down at acquisition. Entry I is different using the partial equity method. It eliminates the parent's equity in the sub's income and reduces the investment account. So, if you look where they explain consolidation entry I, make sure you're there for, there it is. There's some journal entries that they show you the partial equity method. It's my page 102. 101, 102. As discussed earlier, under the partial equity approach, the parent's record keeping is limited to 2 periodic journal entries: the annual accrual of subsidiary income and the recognition of dividends. So there is no amortization recorded under this method in the investment account. Then they show you the journal entries. So the assumption here, it looks like, is that the income is $100,000 that was recorded. Well, we need to eliminate that. Okay. So we will debit the equity and subsidiary earnings for $100,000 and credit the investment in some company because we would have recognized it in the investment account. We would have eliminated the dividends declared, just like we do when we use the equity method, because partial equity method reduces our investment account when we receive them. And those, and what do we mean there, our investment account? The parent's investment account, keeping track of the subsidiary. So we'll debit the investment in some company, credit dividends declared. We still record entry E as we always have to record that amortization. That doesn't change. Okay, so what we're focusing on here is the differences in consolidation entries because of the way the parent records transactions related to the investment during the year. Equity, they put everything in the investment account related to the subsidiary. Initial value, they don't. They basically record it at purchase and just leave it there. They record income only when they receive a dividend. Partial equity, it's a combo of the two. So really read through that and do the problem. Problem 29. So these next couple slides compare the methods. You guys can read through this. Okay. Again, the way the parent does the accounting for the subsidiary has no effect on consolidation totals. No effect at all. Consolidation financial statements require a full accrual basis measurement of both income and retained earnings. Neither the initial value nor the partial equity method provides that. The equity method does. So what we actually do under the initial value and partial equity method is we change the amounts so that it's like the parent always used the equity method. And we do that during consolidation. So what does this mean? I'm looking at now the worksheet for the initial value method 3 years after purchase. So now the beginning balance of retained earnings is different than it is under the equity method. However, and why is that? You see that 1845000 and the parent, and that's the parent, right? Under the equity method, let me see it. Just give me a minute. It's 2020. 1845. Just bear with me a second, guys. I just wanted to check something out before I open my mouth. Yeah, there it is. Okay. If you go back, it's like around your page 97, where it says Consolidation Worksheet subsequent to year of acquisition, so it's year 2020, equity method applied. The beginning balance and retained earnings for the parent is $2,044,000. But using the initial value method, it's $1,845,000. And that's fine. Why did that occur? Because the parent, under the initial value method, never recorded $199,000 of income effects on their separate books. They never showed that as subsidiary income. They never showed it as amortization on their individual books. They did a consolidation, but not on their books. They didn't do journal entries right on their own books. So because they never recognized that on their own books, their retained earnings balance is lower. Well, if you start looking at these consolidation entries after the 3 years have passed, a lot of them are the same as under the equity method. Some are a little different, right? The first thing we do, S, eliminate the subsidiary's book value. So 600,000 retained earnings, 200,000 common stock, $20,000 paid in capital. Credit our investment account. A, debit the trademark, 20, debit the patent and technology. What's left to amortize of that, we already went over that under the equity method. It's the same. You're amortizing that no matter what method you use to account for your investment during the year. Credit the equipment, 12 grand, and debit the goodwill, 80,000. Credit the investment for the total. Okay, but now you still have a balance in your investment account. Why? Because of never recording that subsidiary's income in your retained earnings. So, journal entry I, we remove dividend income and dividends declared because we never recognized any income from the subsidiary under the initial value method. D, there is none. E, we record the amortization of the difference in book and fair value at acquisition, as we always do. And then we have a little asterisk C, which represents that income the parent never recognized on their own books of the subsidiary. So we debit the investment account for that, and we credit the retained earnings for parent. That would have been the balance in retained earnings if the equity method was used. And as I said before, no matter if you use the initial value method or the partial equity method to do your accounting for your investment during the year, at the end of the year, at consolidation, we make journal entries as if you used the equity method all year. That just pumped the retained earnings balance back up to $2,044,000. Okay, so that just talks about any intercompany debts as we talked about before. This is a nice little table explaining these areas. So you want to take a read through that. So again, under the consolidation entries subsequent to acquisition, or anytime during year of acquisition, sorry about that. If you use the equity method, you're going to eliminate the stockholders' equity of the subsidiary at its book value. You're going to create a journal entry for excess fair value and allocate it to the assets and liabilities or reduce them and record goodwill. I, you're going to eliminate any kind of income the parent recognized of the subsidiary. D, eliminate any kind of dividends the parent recognized of the subsidiary in the investment account. E, record your current year's amortization due to that fair value difference at acquisition. And then P, intra-company transactions, payables and receivables are eliminated. Again, under the initial value method or the partial equity method, the journal entries are the same for S and A. In the initial value, the only you'll have to eliminate dividend income as your I. There is no D. And E and P are the same as equity method. And then we saw partial equity method. S and A are the same as your equity method. I, you'll eliminate the equity income. D, any dividends are eliminated, as well as E and P, same as equity. So it's really when we're trying to eliminate income and dividends, that's where the differences are. Subsequent to acquisition, so anytime following year of acquisition. Under the equity method, there is no journal entry *C, but under the initial value method, there is, because we have to increase the parents' retained earnings due to the non-recognition of income. Okay, so you got a lot of work to do there. What I want to wrap up talking about, and I know I'm not going to cover everything there is, but goodwill. After all of that, we have to test to make sure goodwill doesn't lose value. Goodwill impairment testing. And you should have learned this back in intermediate accounting, but I'm going to teach it like you didn't. So under FASB topic 350, it tells us how to determine impairment of intangibles. We're going to focus on goodwill first. So when accounting for goodwill subsequent to the acquisition, so you know that 80,000 Sun had, when Parrot paid more than $80,000 for the fair value of Sun, they had 80,000 in goodwill. Well, does it always stay at 80,000? Maybe it increases. If it increases, the value of the company increases, that's great. But what if the value of Sun decreases? And that's what we have to worry about here. So, goodwill impairment losses are reported as operating items in the consolidated income statement. So, we may need to write down that goodwill if it's lost value. Sorry about that. Okay. And if it does, well, let's see how we would determine if it does or not. It requires an entity to assess its goodwill for impairment annually. More frequent impairment tests are done if events or circumstances change that make it likely that the fair value has fallen below the carrying amount, which would be the 80,000 Parrot has for Sun. If after performing the qualitative assessment, so you're not doing anything with numbers yet, you're just looking to see how much is it worth, things like that. It appears it is more than likely that the fair value is less than its carrying amount. You start a two-step process. Step 1, calculate the fair value for each reporting unit. So fair value with goodwill included is compared to the carrying value, including goodwill, of the consolidated entity's reporting unit. Does fair value of the reporting unit... Good morning, I'll be up in a minute, okay? Huh? Pat went to work. Yeah. Sorry about that. Does fair value of the reporting unit exceed carrying value? If it does, great. No further testing is needed. But if it doesn't, goodwill may be impaired, and you would go to the second step. The second step says, okay, calculate what the fair value is of the goodwill right now and compare it to its carrying amount. So if that implied fair value, or your calculation of what goodwill would be if you bought that subsidiary today, is less than carrying amount, you have an impairment loss. If it's more than carrying amount, then you don't have an impairment loss. So let's look at an example. Assume January 1, investors form New Call Corporation to consolidate the telecommunication operations of DSM and Vision Talk in a deal valued at 2.2. New Call organizes each former firm as an operating segment. Additionally, DSM comprises two divisions, wired and wireless, that along with Vision Talk are treated as independent reporting units for internal performance evaluation and management review. Great. New Call recognizes $215 million as goodwill at the merger date and allocates this entire amount to its reporting units. So here is how the goodwill is allocated. $22 million of it is allocated to wired, $155 million is allocated to wireless, and $38 million to Vision Talk. New Call tests for goodwill impairment. DSM wireless fair value has fallen to 600 million. So at acquisition, it was at 748 million. Now it's at 600 million, well below its current carrying amount. The company attributes the decline in value to a failure to realize expected cost saving synergies with Vision Talk. Okay. So New Call has to calculate an implied fair value of goodwill. How did they do this? Well, we first look to see what's the fair value of DSM wireless. So what would it sell for? What would a smart buyer pay for it? What's the fair value then of the net assets of the company except their goodwill? So there's a listing of all of their company's net assets. So DSM Wireless would sell for 600 million. The fair value of its net assets are 596 million. So at December 31st, the implied fair value of goodwill is only 4 million. People would only pay 4 million more than the fair value of the net assets. Currently, New Call has goodwill listed at 155 million. Definite impairment. That goodwill has decreased over the year due to this issue that they just talked about by $151 million. That is recorded immediately. We would debit a loss on impairment and credit goodwill at consolidation. Okay. The reported values for all of DSM's Wire's remaining assets and liabilities do not change. ASC requires special allocation of testing procedures if a reporting unit has a zero or negative carrying amount. In that case, it permits an entity to skip step 2 unless it is more than likely than not that goodwill is impaired. The entity must consider the same factors as in the qualitative assessment. Okay, so read through that, finish reading through the chapter. That's a great table on my page 108 of all of these consolidation entries, but that's really your focus for this chapter and number 29. I want you to get through number 29, work on it hard. Monday we're going to go through it and wrap up chapter 3.